One Roth conversion mistake can cause you to pay thousands of dollars extra to the government each year, and it has nothing to do with taxes. So in this video, I'm going to show you what this trap is, how to tell if your conversions are about to trigger it, and how to avoid this hidden cost without giving up the tax savings. To start, I need to show you how you can do everything right on your taxes, but still lose thousands of dollars each year using Jim and Karen as an example. This chart shows their tax bracket throughout retirement. If they do nothing, they'll end up paying all of these taxes in a higher bracket later on. But earlier in retirement, there's all this empty space at the lower rate. So when we add in Roth conversions, they look like the perfect solution because they use up all that empty space. But what Jim and Karen didn't realize was that these conversions were about to trigger a hidden cost that hands the government thousands more than they need to. Let's switch this chart to show another set of brackets, the ones the government uses to calculate Medicare premiums. Every time your income crosses one of these thresholds, it means having to pay more money for the exact same Medicare coverage. And when we zoom in, you can see where their income falls relative to these levels. Right here is their income without conversions. And right here is the threshold that triggers higher Medicare costs, called an IRMAA surcharge. Without the conversion, their income is well under that number. But Roth conversions get added on top of the income they already have. So when they do the conversion, it pushes them above the IRMAA threshold. And even though they did everything right on their taxes, they still end up paying thousands more each year for the same Medicare coverage. And if you want to see if your conversions will trigger higher Medicare costs in just a few minutes, you can get this same software for free using the link below. But knowing about the IRMAA trap is just the beginning, because if you don't know when it kicks in, you might already be triggering it. For anyone on Medicare in 2026, their premium cost was determined in late 2025. But the Social Security Administration didn't have their 2025 income yet when they calculated the cost, so they used their 2024 income instead, which means if you're 63 or 64 and not even on Medicare yet, your income is already affecting what you'll pay in premiums. But even when retirees know about the 2-year look back, many still trigger IRMAA anyway, even when they think their income should be below it. This chart shows the income tax brackets for married couples in 2026. You can have income up to $211,400 and stay in the 22% bracket. And this next chart shows the Medicare brackets. For income up to $218,000, you don't have to pay anything extra for your premiums. So most retirees think, perfect, I'll just convert up to the 22% bracket and I won't have to worry about triggering higher Medicare costs. But here's what actually happens when you do that. This is the chart we looked at earlier that shows Jim and Karen's income and where it falls when they add Roth conversions. They convert perfectly up to the 22% bracket every year. But when we switch this over to the Medicare brackets, they're pushed over the first bracket and into higher costs. So if the 22% income bracket is lower than the level that triggers IRMAA, how can they be perfectly under the income bracket but too high for Medicare? The reason is Medicare calculates your income differently in two ways. First, it counts income sources that your tax bracket doesn't. Things like capital gains, qualified dividends, and municipal bond interest. These don't affect your Roth conversions, but they do affect your Medicare costs. Second is the standard deduction doesn't apply. So unlike your regular income, nothing is bringing that Medicare number back down. And when you combine those two things, it's what pushes Jim and Karen over the threshold for higher Medicare premiums. So now that you know why this happens, let me show you how to avoid it while still using Roth conversions to save on taxes. Let's go back to Jim and Karen's income tax bracket chart. Later on, they'll be pushed into the 24 and 32% bracket. So every dollar they convert at 22% now avoids that higher tax rate later. But as we just saw, conversions up to the 22% bracket can trigger higher Medicare costs. So how do they decide between higher taxes later or higher Medicare costs now? Across the bottom, you can see that right now they're 62. So for one more year, they can still fill up that 22% bracket without worrying about IRMAA. But once they turn 63, the strategy needs to change. So instead of telling the software to target the 22% income bracket, we're going to target the Medicare bracket instead. And then we set the conversion to stop right before it triggers IRMAA. And when we change the strategy and switch back over to the Medicare brackets, you can see their income stays perfectly under that threshold. So the key isn't to stop converting, it's to switch your focus from income tax brackets to Medicare brackets once you turn 63. But I know what you're thinking. We just saw all the differences in how Medicare calculates income, and it can get complicated. So how do you know exactly how much to convert and still stay under these thresholds? If you want to do it by hand, the number Medicare uses for income is a version of your modified adjusted gross income. You can calculate it by taking your adjusted gross income, which is on line 11 of your 1040, and adding on tax-exempt municipal bond interest, which is on line 2A. So if you want to do Roth conversions, the conversion plus that number is what needs to stay under the IRMAA thresholds. But if you don't feel like doing the math, this next page maps out your income each year and tells you the perfect amount to convert. So if you want to save yourself hours of math and see exactly how much to convert and when based on your numbers, don't forget you can get free access to the same program below. But even if you know exactly how much to convert to avoid higher Medicare costs, you still might end up paying them anyway. And it's because at age 75, the government starts forcing you to take out money from your retirement accounts each year, and it can push you over those same thresholds. So to avoid paying tens of thousands more in extra taxes and Medicare costs from your RMDs, check out this next video.